Hi, this is Mike Swanson here. We're going to talk today about how to use the 20-day Bollinger Bands to time your trades and understand what's going on with the markets and, more importantly, what's about to happen, because that's really the key. Now, these are some of the most popular indicators used for technical analysis, for analyzing the trends of a stock, an ETF, or the general stock market, and we're going to do all that. Now, these popular bands were invented by John Bollinger in the 1980s. There's a picture of John right there, in fact. Now, what are these bands and why are they so popular? Well, take a look at this chart. This is TLT, the 20-year Treasury Bond ETF. The bonds in this chart are pink, and they're the 20-day bands I'm using in this instance. They're the default settings if you use stock charts and many other popular charting software. Some of them use 15, but most use 20. I tend to use the 20 myself and the 200-day for analyzing the long-term trends. That's another topic. Let's stick with the building blocks of understanding how they work with the 20-day trend. So what the bands are is they use the 20-day moving average. You may, if you look very carefully, that's the dotted line in pink here, and they have a line above the 20-day moving average and a line below the 20-day moving average. What those lines are standard deviations above and below using a simple percentage calculation. Now, what this does is it gives you an idea of if the price usually is contained within these standard deviation levels. Rarely does the price go through one of these levels, and if it does, it comes back down most of the time. So some people use this indicator as an entry-exit point. If the price is hitting the lower band, they'll try to buy, sell at the higher band, jump in and out. That's a very short-term orientated type of strategy. I don't really use it for that. I use it to understand a different thing, which I'm going to explain in this video, this presentation. So what is that I use it for? And that is to measure price volatility. And here, if you take a look, is the simple mathematical formula to help you understand what's going on here. And what's key is the upper and lower bands. They are measuring the standard deviation of the price, but they move closer and farther apart by how that price itself is becoming less volatile or more volatile. And that's a key concept, which we're going to look again, because this can help you understand if a large price movement is to come. What tends to happen is price volatility shrinks when the bands shrink. And that's a situation that happens often before a big move is about to happen. That helps you get ahead of a big move or prepare for a big move. So the Bollinger Band width, when it becomes very narrow, suggests that volatility compression is going to end and the bands are going to then start to go wide apart. Doesn't tell you what direction that's going to happen, but it tells you that it's coming, which can be just as important to prepare yourself. So if you look at this chart closely, you can see that the Bollinger Band width indicator, which is measuring the width between the two bands, when it gets low, that means the bands are being compressed. And I've highlighted on this chart key moments on this TLT ETF where that's happened. And what has immediately happened afterwards is you would have a move out of the bands that would make the bands start to compress, and often this TLT would ride up for nice trend move. So the bands can be used for swing trading situations that last more than just a few hours, but days, sometimes weeks. You can see how this happened in January, and I've marked that with the arrow on this chart. It also happened in March, that move only lasted a few weeks, but the move in January was a big move that took TLT in a breakout situation above 132.5 to 142.5. Same thing happened in the beginning of 2016, which I've highlighted. TLT went from 122.5 to 132.5. In November, it was a breakdown that happened, November 2015. A very short-lived one and a short-lived move in September before. But this is a much more reliable way to trade than simply trying to buy when something is at the lower band, sell when it's up the upper band. In this type of swing trading type of signal usage of the by using the 20-day Bollinger Bands must be incorporated with looking at the big trend of the market. To do that, I use stage analysis. Are we in a stage 2 bull market, stage 3 topping market, stage 4 bear market, or stage 1? In stage 2, you want to be looking for consolidation entry points to buy or dips to buy. That's how you do in a bull market. In bear markets, you want to sell rallies and so forth. In stage 3, you're looking for a transition from that's going to lead to a big drop. So let's take a look at how this can be used with the HUI Gold Bugs Index, because this has been in a powerful uptrend for much of this year, and these 20-day Bollinger Bands could have been used to spot the end of consolidation periods and immediate up thrusts to time entry points in this market. You can see how that could have worked in April. You can see how that could have worked in July. However, right now in August, the bands were signaling that a move was coming, and this time it was down. So that suggests that the big momentum rally from February to August has actually come to an end, and we're in some sort of pause situation. Interestingly enough, from July to January, or July 2015, January 2016, there's a stage 1 base going on, so you can see how the bands signaled little drops that weren't sustainable. That told you something was changing. In 2015, though, before the bottom that August, we were in a bear market in which the bands would signal dumps were coming, and they did. And that's what was going on for the preceding couple years. So when you put the bands in context with the stage analysis, what the big trend is, then you can use them to create entry points in that trend and spot the end of consolidation periods in bull markets that precede big moves up. So what's going on with the stock market right now? The past couple years have been very interesting with the 20-day Bollinger Bands because they have not signaled big rallies up. They've signaled immediate drops, which actually turned into fast drops, then moves back up, which didn't really lead to anywhere until finally the market broke out in July, but really hasn't yet gone anywhere. What does this mean? Well, let's look at August 2015. The 20-day Bollinger Bands compressed. They became very narrow, and the market dumped. It broke its 200-day moving average and had the flash crash of, I think it was August 25, 2015. Horrible situation, but the market bounced and went sideways and rallied back up, and then in January the same thing happened. The bands compressed, the market dumped. But then in February and March it had a similar bottom as it did from August to October 2015, rallied back up. What does all this mean? Well, it means that I think we're in this, that all represents a giant stage 3 topping process, because in bull markets such compression leads to big rallies, as you saw with the gold stocks the first year of that bull market there. Instead, we had dumps in the context of a stage 3 top. Now finally, it took 3 years to happen, but this July the S&P 500 went through the 2125 level and stayed above it for more than a few days, but it hasn't really gone anywhere yet. And the volume has died out this August. The volatility has died out this August to the point similar to where it was in August 2015, except this time it hasn't immediately dropped yet, which in itself is very interesting. It's something that is a very rare situation with these 20-day Bollinger Bands. In fact, you've got to go all the way back to 1993. That's over 23 23 years on the stock market. So it's a very rare situation we're in right now. So we're in a holding pattern where support is really Friday's low of 2160. Resistance is the upper band, really 2200, let's say. And we're drifting. But a close above that upper band or below the lower band will create the next move in the context of what I believe is a stage 3 top. And there's other reasons I think that that's the case besides just what I'm talking about here. I'd have to go into deeper and more videos. But in the context of that, a break of 2160 sometime, let's say in September, will lead another sustainable drop as we saw last fall, last January, back down to the moving averages at the least, and then we'll have to go from there. But it could be a very significant move. So right now, the Bollinger Bands are telling us that we're in a very unusual situation, and they're very useful to use to understand what's happening. That's why we pay attention to them and so forth. And I'll be keeping you up to date in videos what's going on. So this is the first time you've come to this website. You need to opt into my free email list to get more videos like this, to get my daily information when it comes out, and emails that go into more detail. I put charts in emails and and all kinds of good information. So do that. We got a lot more to talk about going forward, and I'll see you later.